Hi, this is Randy Finney with Right Side of the Chart. This is a mid-session update for Friday, November 3rd, 2023. It's 11:50 a.m. Eastern Time. I'm starting the video, and I'm going to do this one kind of in reverse a little bit. What I mean by that is I'm going to start out with some of the other trade ideas. Other trade ideas being other asset classes, things that have little, if anything, to do with the stock market. Lately, I've been so hyper-focused on the stock market coverage that it kind of pushes off those trade ideas. And as always, use the comment section. It doesn't matter if it's related to a post I put out. I can put out a post on Treasury bonds, and if you want to ask my opinion, update on natural gas or wheat, and that's what I'm going to start with here. I had this one I just responded to today. Somebody asking me for an update on UNG, which is a natural gas ETN, and wheat. So let me start out here. UNG. Just read it off real quick. You can, of course, check it on the site. I believe it was under the second to last post before I did this video. And so I gave UNG a 60-minute chart with the previous one I posted on Monday showing a near-term outlook. And here's what I said. UMG has a nice uptrend line on the 60-minute chart, and that also shows on the daily, by the way. And that can be used to go long on pullbacks. And I'm still waiting. It's been a long time, but I'm still waiting for a solid breakout above T2. That's my second price target from way back when we put in the divergent low, which is still the low in natural gas. And once that happens, I've been maintaining for months. That'll likely spark a rally that'll take us up to T3 and T4, my next longer term targets. And I said also note the recent divergent highs and lows, which will help identify the pullbacks and rallies. So this was the other day. This was Monday. Posted this on Monday. Might have been on a reply to an update on natural gas. Same thing. And we were right here at 695. That's price support just above the trend line. But we had just come off the trend line already, and so there was a nice little pullback there. See, these are those little divergent highs and little divergent lows within the trend. We've been moving. The big picture is this. I have the purple levels boxed here. T2, remember, we were long off this divergent low. T1 was, goodness, I don't know. I've added lines since, support and resistance levels. But for the most part, I think it might have been up that's just below there or right around there. So we hit T1 then, had a pullback, put in a little wedge here, had a breakout, ran up to the top, hit my second target right here, hit it again here. Even back then I stated, we had, as usual, the initial tag of a price target typically results in a reaction. That's why I list multiple targets. We certainly had one. Took us back down. We rallied up again, hit T2. Remember, these targets are not random. They're always, almost always at resistance levels. And so that's it. It's about $8. And, we've been working our way up. It's not a powerful uptrend. I really call it bigger picture sideways, but slightly upward. Really, if you take the uptrend line that I've been using here, and then the top of the range at about $8, that gives you an ascending triangle pattern. Those are inherently bullish. Doesn't guarantee they'll break to the upside, but they usually do. And so that was Monday. And then today, the updated chart, you can see that was right here. If I can, hopefully it didn't cut out in the video. Well, let me zoom back out because it might have. That's where we were, and that's that lift up we had. And then we did put in here, you know what? Let me just go to the current chart. It's a lot easier. I've just screenshotted that one today, but that was it. So we've been bouncing off this trend line. That was where we were Monday. Had these up arrows. We went up. We hit that 754. Those are all levels on the target on the charts previously. Put in a small divergent high, and that's it. So you can swing these little divergent highs and lows. But ultimately, I have us working our way up here. And again, it's long. This is a big level. If we take out that uptrend line, then that's going to open the door to move back down, maybe even run at the lows. But, natural gas is coming off. It's trading at multi-year lows. We're still in an inflationary environment, don't get me wrong, or anybody, don't lose sight of that. Yeah, in fact, I'm going to roll into some of the other commodities here in a second. Let's do that now. Let's go back to the that post. Close that out. So there's my update on natural gas. Still, it's more of a swing trade within that range. But once we pop T2, I really think there'll be a lot of pent up demand and it should run. But we need to take that level out. The other one was wheat. Wheat still looks good in my opinion. We had a reaction off we had the typical reaction off the initial tag of T1. That's from the last chart I posted on the site, and I'm going to get to in 1 second, with another thrust up to T2 likely. So the previous post, last time I did an update, posted a chart on it, was here, September 15th. And yep, that's it, September 15th. And it's going up here, T1, that's first target. And I said it's around the $6 level. And, arrow breaks denote a pullback or reaction. So I don't, I used to draw all the little minor squiggles, but you can, an arrow break, that means you're not going to go right through there. You're going to get a reaction first. So that was, again, what was that? September 15th. This is today. And that's it. So from there, we went on. We hit T1. It was almost exactly here. I'll go to the updated chart. Even I just screenshotted this today. Wheat, WEAT. That is the wheat ETN, tracks wheat futures. We hit a high right there that day. Remember, always sell before the actual, I've just listed the resistance levels, and that's why I called it 6-ish. You want to always sell your longs slightly under the resistance level you're targeting in case the buyers step in early. We hit a high of 597. Oh, no, I'm sorry, a high of 604. So that's definitely a hit of T1, followed by the typical reaction form of a pullback. We're still making higher lows right now, and we've turned up, so that's good. Tight stop could be put here below this previous low, because if you take that out, then that kind of doesn't eliminate things. You'll still have positive divergence if you go down and then reverse. But either way, we've already had the reaction. So that favors, the odds favor if we run up there again, whether we have another reaction or not. Once we pop that level, and it increases the odds since you've already checked it once, that you will pop through there and then hit the next targets. The only thing I did different from the previous chart is I added T5 way up here. I just left these lines here because wheat's been a great swing trading vehicle. We've had these divergent lows, pops, bigger divergent low. We had this as 4 targets here, 1, 2, 3, 4. Fourth and final target we hit. We reversed. I posted it, shorting it on the site then, and I think here as well. I had pullback targets. And so that's it. So bigger picture, guys. And like always jump around to time frames. This is the daily chart. So we were just looking at a 60-minute chart. And on the daily chart, we continue to build these positive divergences. Commodities by every metric that I look at, just like Treasury bond yields, are in a new bull market after ending a large bear market back here in 2020, right around the time COVID lows hit. And, so we've been building this divergent. We had a couple runs, T1, T2 hit, made a marginal new low, but still a divergent low. The same positive divergence we had at that low where we hit that T2 has only grown larger now. And there are no guarantees, but typically the larger the divergences, the larger the ensuing trend change. So, anywho, we've already hit that level, so if we can pop up there, we could have a nice run all the way up to these additional targets in wheat. So there's your longer term big picture. And remember, at the end of the day, wheat has nothing to do with the stock market, so it's a nice way to be diversified. It's a different asset class. You can trade, other grains like corn and wheat tend to move together, and corn has the same thing. Big positive divergence has been building by most metrics. When you look back longer term, bigger picture, like I said, these guys finished a bear market that started all the way back here and bottomed in 2020, and by most metrics, meaning it's taken out the primary downtrend line. Almost all commodities have just about taken out primary downtrend line, taken out all the multiple previous reaction lows, and have been putting in higher lows. This is just easily, to me, the early makings of an uptrend with more to come. So I'll continue to look for objective opportunities, and we'll trade pullbacks and things like that along the way. But nice support here too on corn right there at about 21.88. You can see we had resistance back here and support. If it breaks it, what's it going to do? It might have a little false, whipsaw, try to shake out some longs, suck in some shorts, because any marginal new low, as long as we reverse, will still be a divergent low. And then here's your downtrend line. It's a big old wedge right there. So anyway, that's what that looks like. The other grain, as they call it. They put it in the grain ETFs as soybeans, and that's what that looks like. Not as clear right now. Wheat's looking the best to me, and corn looks pretty good. These guys tend to move together because, again, there's JJG, if it's still out there. Yeah, there's the grain. Oh, they redeemed that one. We used to be able to trade JJG, which had corn, soybeans, and wheat all in it. But the iPath, they delisted and stopped. They redeemed a lot of these ETNs. One of them was, what was that? We used to trade a lot was... coffee, for example. So some of these trade ideas I've had to give you recently, and it's a shame because I think what it was is after years of a bear market, like you look at, JO used to be JJ, same issuer had it JJOFF, and this one got delisted. It still trades. It's a basket that still, I guess, rolls into the futures. I don't know why they're not actively supporting it anymore. But anyways, you can see kind of the bear market in coffee, and the same thing I just gave you in wheat and corn. So my guess is after years of a bear market, people lost interest in trading these, and it just wasn't profitable. I don't know. So with that being said, I've been giving you trade ideas on the individual futures for those of you that trade. Please give feedback, because if I don't get a lot of feedback, and I know that a lot of people don't trade futures. They don't know what they are, how to trade them. They don't have a futures account. Maybe the leverage factor is too high. It's a whole different knowledge base you need to know, especially with these agricultural commodity futures. Sugar and some of the coffee, they're quirky. Some of them trade over, based off, London time, London exchange. So some of them have quirky trading hours. A lot of them do. And again, you need to know that. You have to know the roll dates and all that other good stuff. So, but if one person tells me they like to trade, I trade them. So if one person says, "Hey, Randy, I like it," and I know I do get a couple of those. But the more I get, the more I'll post those trade ideas. Again, if they come out with another ETF or ETN that tracks coffee, great. I'll start posting that as well. Until then, last trade idea I gave you on coffee was coffee futures right here, KC. We had a divergent low, bullish falling wedge breakout. I can't remember if we were long at that wedge breakout and or that one. I know I stuck with it. I believe it might have been the first one, and we put a ever so slightly marginal new low. Went on to hit my first target. Perfect reaction off there. Hit T2, but powered on through, so you don't always get reactions. Hit T3, pulled back to T2, even though we didn't get a reaction. It was resistance, and resistance once broken then becomes support. That was an objective re-entry if you're still longer-term trading this. Then we got ahead of ourselves, nice and rally off the lows. Put in negative divergence there, a little wedge break. Pull back, and you can see you see my lines. Right now we have a divergent high, but coffee, and I said this before on this trade, when coffee wants to run, coffee reminds me a lot of natural gas. When that sucker wants to run, it can just keep running. Lumber is another great example, and it makes overbought. It can tear right through overbought readings, burn right through them. And so, I think sooner than later we'll probably start the next leg up in a lot of these agricultural commodities. I even believe, yes, I did recently share DBA with you as if you don't trade futures, you don't have the skill sets or the inclination or time to trade these individual commodities. I tend to be selective right now, So I said recently I'm short orange juice futures and long, other things. So. But if you wanted just a one-size-fits-all ETF, then this is your guy right here, DBA. I haven't updated this in years, but it doesn't change much. You've got them all the agriculture commodities. So in other words, that excludes things like crude oil and precious metals and other things. It's just the ag commodities: cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, lean hogs, feeder cattle, cotton. So again, you can go to the website and get the updated holdings, but this is one that I have in long-term accounts. An account that I don't actively trade as much. I have a lot of accounts, IRAs, kids' college funds, all those kind of things like that. And I think this is just a good way to be diversified asset allocation. You guys know my long-term views on the stock market, and Again, so there it is. And it's working its way up. It's in an uptrend. It had a correction, and by all metrics, like I said, commodities embarked on a bear market back here when really the last bear market in stocks happened back. This is 2007, '08. Remember the 08 to '09? And we were in a bear market, and that ended in around the time COVID hit and the stock market bottomed out. And again, by every metric that I have, including the primary downtrend line, we're in a new bull market. So that's just the initial leg up, and it was a heck of it's a nice strong one. Corrective wave back to support. Next leg up, and so once we pop 23 or so, then that should give us the next leg up in ag commodities. So that's kind of long-term stuff. I just mentioned OJ a second ago. That's been okay, that was a quick look at some construction demo photos going on here. This is OJ Futures. Again, one of, just like I said, tremendous amount of profit potential. I updated this and gave you some additional targets on another chart, a couple other time frames. But just a nice one so far. And again, my point on this being that, at the very, same time I might be long, live cattle at the same moment that I'm short, orange juice futures, which we shorted that one the day of the high, got that out to you, and so far that's down in just a few days, 18%. Like I said, I love these. You don't get these often. Parabolic runs, you get those sell signals. It's just like I said, typically the move coming out of a parabolic uptrend is as, if not sharper, than the move down. Think of the dot-com bubble back in 2000, or go look at that if you weren't around then and see what happened. Bitcoin off the highs, things like that. Okay, good. I'm doing good on time. We're only 17 minutes into the video. Now we'll kind of start to segue towards the stock market, but I got a post out to you today that kind of shared my thoughts and kind of backing off, or just kind of stepping back on the equity, bearishness right now. Last night, I'm, sitting in bed, it just kind of processing as I do. I'm probably the only person out there I've actually dreamed sometimes about trading. I can see charts in my head and sometimes see trades happening. It's crazy. But this is what I do. This is my passion. This is my life. So, but then it hit me. I've been stating treasuries being one of my, most bullish trades, and even shifting a good chunk of my wife's 401k. I don't actively trade in there into treasury bonds, treasury bond funds for this reason. Like everything else, I'm usually, when everyone wants to be short or nobody wants to be long, that's when, and again, not for the sake of being contrarian, but you can see it's just been a beautiful setup. Look at these gaps. This is impulsive, pop, 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 since the breakout. Remember, I first gave it to you right off the low. We broke out, so the breakout occurred with the low. So we're in at the bottom. T2 got hit today. I gave you that update, told you reaction's likely. This is what a reaction looks like. I define a reaction as one of two things. When you're going up, a reaction, when you hit a resistance level, a reaction can be one of two things or a combination thereof. It can be a pullback, that's a reaction in price, or it can be a consolidation, which is a reaction in time where you trade on that level, or sometimes a combination thereof. But bottom line is, we hit that level this morning, and this is the reaction. So far, it's the more bullish of the two. A reaction in time is, and it is a little bit in price as well. We pulled back, and I think we could go back. But let me just really spend some time on these charts, and then if time permitting, I'll get to the equity markets. If not, I'll do that in another video. But just understand the importance of this. And here, if there's any confusion as to what the stock market's doing and how important rates are, let's take a look at that. Let's turn off all the lines. TLT being bond prices. Remember, I talk about bond rates and prices. Those are inverse, opposite one another, and there is zero deviation to that correlation. What I mean by that is there's all kinds of correlations in the markets between the US dollar. Gold, for example, is a great one. Gold typically goes up when the dollar goes down in value, and vice versa. And that's simple math, because if you freeze demand, supply and demand, and all other forces, then a falling dollar it takes more dollars to buy 1 ounce of gold. So that's very simple, easily explained mathematically there. However, in a perfect world, there are different forces other than the dollar. Sometimes there can be overwhelming demand for gold that may offset the effects of a rising dollar, which usually pushes gold down. So that is a fungible, I guess you'd say, kind of correlation, one that can change. The relationship between interest rates and Treasury bond prices is immutable. It is a direct correlation. There's no ever any variance in it. So that's just understand that. Now, the forces that make the rates or bond prices go up and down, of course, there's a lot of forces that come into play there, and I talked on that in that post earlier today. So a couple things can make interest rates go down, as I'm forecasting, and so far they have. And I just want to show you, for those of you that might don't take things on face value, looking at the stock market, we can look at QQQ, or you can look at SPY and see recently the fact you can see this correlation. This is, as I said, I'm using candlestick versus line, but look at the turns. Treasury bonds rally, that means rates down. The stock market likes it and goes up. Then the minute they go down, it sees rates falling, stock market goes down. Bottomed here, and once it became clear that Treasury bond rates were going up, look at this explosion in the stock market, QQQ. Again, this, something back before we even had this little kind of breakout to new highs in rates, which is a multi-year low in Treasuries. That's what I predicted, that the stock market would become hypersensitive, tick by tick. And it has, to rates, because we hit that kind of what I call that red zone on the tachometer where things would break. And we saw it. Mortgages came to almost a basic halt. And in the stock market, knew that would feel the pain, not just mortgages, but everything. So we had really nowhere from a fundamental perspective. Again, our TLT trade was based on technicals, but fundamentally rates just couldn't go any higher. Like I said, they could technically, but things would crash. The whole financial system was pinned at the red line. Banks, regionals, big banks, everything. And so anyway, so that's where we're at. And again, this trade was originally given to you on a 60-minute time frame. We hit T2 today, but I also gave it to you, followed up a week or two ago, giving you this bullish falling wedge on the daily. So for those of you that want maybe a little more evidence, you want to see a breakout on a daily, and that's it. And I gave you, to keep it simple for swing traders, two targets. T1 right here, which we're only about halfway, maybe 2/3 of the way to. And then potential T2. We have price resistance and downtrend line resistance in this area here, and the 200-day moving averages. And so that's where I think we go. And now, again, that would and is, let me just be very straightforward, that is a net tailwind for stocks. However, this relationship, even though stocks have been and may continue to be hypersensitive and trade right in line with Treasury rates, so by going by this, it's very hard to get too bearish or too short until I see this play out. And this may not play out. I'm going to get to some things in a second that could really put the brakes on the stock market and this Treasury bond rally. But again, that is the most likely scenario. So when I say that it should be a tailwind for equities, falling interest rates, especially in such a hyper sensitive environment, in other words, because we're pushing multi-year highs, we hit the red line on rates, that should be a tailwind. However, if it stops becoming that, because I used that analogy recently several times about, a hunter shooting its prey, going out deer hunting and, missing the heart, not a kill shot. I hate to be graphic. It's just an analogy in my head. The deer got shot, but a major artery was hit. It's it's not gonna die right away. It's gonna run off. Hunter's gonna follow the blood trail and then find the animal 50 yards away, finally passed out. And I think that's what's happened to the economy with these high rates. So where I'm going is we can see this in the stock market going up are they can be mutually exclusive. It's not necessarily it should be a net tailwind for stocks, but it doesn't have to be, is what I'm saying. We can at some point, and that's that post I got out to you today, we'll watch the equity markets carefully. We'll look for key stocks and sectors running into resistance or failing where they should or failing breakouts. There could be 101 reasons. And if we start to see that, there could be a point, and I suspect there will, where this morphs into more of a flight to safety, institutions getting out of stocks and getting into bonds. And so right now it's an abatement. The reason for this rally, if I want to play the game the media plays, because they will always cite a headline, I've always said this, they will assign a headline to any big move in any financial asset, particularly the stock market or bonds or gold. And I've seen them pull, I'm sorry to be graphic, they pull shit out of their ass sometimes. They just make up something if they don't know a reason. This was technically induced, but it was also fundamentally induced. We knew the Fed would pause. I'm shocked that, others weren't front running this trade like we were, because we knew that would be the net result, and they seem to want to wait to, Powell made it official. So, there, by all means, you should have been positioned before this big move. People now are just reacting to kind of what's old news. And again, there's some powerful technicals in play. Let me show you this, and now let me talk on this real quick. Okay, so this is TNX. This is what I just showed you. Well, we were looking at TLT. Remember, I told you guys recently I'm favoring the 30-year just for the juice. You're going to get, the duration on a 30-year bond's higher than the 10. That means a duration is how much a bond moves, and the price of the bond moves in relation to a change in interest rates. And so higher duration just means it's more volatile, more upside, and when rates are going down on the bond prices and vice versa on the longer term bonds. But the 10 years is kind of the benchmark. It is what the 30-year mortgages are more responsive to the 10-year bond than the 30, believe it or not. And so that's what a lot of folks on Wall Street, the pros, watch. And this is my daily chart. And you can see right now, I'm zooming. I've had this trend line here for quite a while. Created that thing back in March of 2022. This is our primary bull market uptrend line for yields, which remember is opposite bond prices. Again, the technicals to me were very strong. I foresaw this breakout to new highs, and that's when the market was cheering, and a lot of folks on TV and in the media were saying buy bonds, they're done, the rates are over. It was actually back here because we started moving lower. Then we started ticking up. Then we yields broke out to new highs, and it's not mere coincidence when that happened. Remember, the stock market peaked right about mid-July, and when this started happening, then boom, we went to new highs. And so this is the fundamental reason, not technical. We were short the markets mainly for the technical reasons, meaning the charts on the NASDAQ and the big stocks, but also fundamentally. So this is the fundamental cause for the recent correction in the stock market, and this is the fundamental cause for the recent rally. And again, this is almost tick by tick, and that's why you've seen the sharpest rally in 3 days and months, because this is the sharpest drop in yields. And it's not just a random, see, that's the thing I always say about this. I get a lot of comments on a big day or a big up or down day in the markets, and people ask my opinion. I say, look, it's noise if it happens just randomly. A 3% up or down day in the NASDAQ is just noise unless it's technically significant. What does that mean? Well, here's our uptrend line. So the way I've drawn it here, we could actually say we're right on it. Let me do something here. Yeah, so I'm gonna say that. I'm gonna actually acknowledge that. I'm gonna put a different board here. Oh, here's another one. It's a different board. Let me extend that. So look, here it is, guys. We're right on there. In other words, remember recently I said if you have to squint to see if you've broken a support or resistance level, then you haven't. You want to give it the benefit of the doubt. So there is a possibility here that although the technicals, the negative divergences indicate that we're probably going to go lower in yields, the yields could have a little surprise bounce right here. And remember, let's not forget where we started the day. I got that out to you. TLT ran into resistance, one of my targets, as did ZB. And so if we have a deeper pullback here, again, with the market being hypersensitive, and what that would mean on TNX, the 30-year, is it means it could would mean that this uptrend line, see I have it on different boards. This is a 60-minute chart. So right now we've broken down, and that's bullish for bonds. But again, when I flip out to the daily chart, depending on which way you want to draw the line, you can say, you know what, we could be, if you draw it this way, right on that line, close enough to say, no, we haven't yet taken it out. Okay, so where am I going with this? Just watch it. I can't tell you what this is going to do based on the negative divergences and everything. I think this level is probably going to break soon. And if it does, that means yields go lower, bonds go higher. We hit that target I gave you on T1 a minute ago on the daily chart. And again, that should be net bullish for equity. So I think it's prudent to... Okay, I had to pause the video there for a very important phone call. That was the adjuster at Progressive finally getting the last draw on her insurance claim from a year ago, getting that released. I think accidentally in this video I had some of the photos from the damage in there. Anyways, so that's good news. And I can't remember where I was. That's why I mentioned that I paused the video to have that conversation with him. And anywho, okay, so that's it. Look, guys, we're by this draw right here, the 10-year is at support. By most accounts, it looks to me like there's going to be more upside in bond prices, more downside in yields if this line will go. But as you've heard me say 1,000 times before, support is support until unless broken. When you look at the bond prices, go to IEF, that gives you the 10-year. And let's see if I have some lines there. There it is. So look, here's IEF. I haven't even queued this up before the video. And this is how I have the trend line drawn. Let me fine tune it. By fine tune it, when I'm coming right on the reaction highs here. 1, 2, these candles started. Third reaction there. Fourth right about there. So that's it. We've rallied into resistance, as I showed you first thing this morning. There's a lot of... I think everybody is now realizing what I've been saying, that look, bond prices to RR look very favorable. So we can see there's been you can see the volume too. A lot of buying here. That looks like a potential selling climax. And so my guess is we continue higher, but that's a guess. But I can tell you factually, we are at resistance right now in the 10-year. And so if we can't power through here, and we have a pullback, and if it's anything more than just a minor pullback, I think the markets will be fine with that. But anything much more than that, and remember, the Fed is still, I believe, I didn't listen to all his commentary, I believe they're still in quantitative tightening mode. And so instead of being a net buyer of bonds, they're a net seller of bonds. I tell you what, it'd be a good time right now for the Treasury to be, if they really want to lighten up the balance sheet, to be selling into this strength. And but unless that happens, like I said, the stock market's going giddy over this, and it should, like I said. Oh, and then I'll wrap up. I know we're getting a little bit long into this. What I wanted to do, because it does, segue right into this. The key levels, QQQ. Let's not forget this was and still is a potential target. This is our primary bear market downtrend line. We're coming up to that now. Apple, which is the single most important stock, the NASDAQ 100, as I said, ran into that trend line yesterday. So far rejected. Nothing bearish. It's just a reaction off there. Again, I think I said yes, I'd be surprised to see with all that energy expended to get up to the trend line, it would be unlikely to just blast on through there. So all that is a reaction now. However, resistance is resistance until unless taken out. So there's that. QQQ coming up on that as well, the primary downtrend line. And then real quickly, if I can do this in a minute or less, all the key sectors. XLK, again, this is a daily candle. As of now, we're breaking out, but we haven't closed the day yet, so watch that. There's the primary downtrend line. Why did I pick XLK? I'm going through the sectors of the S&P 500 now, this being the largest by far. Roughly 26% weighting. Everything else really doesn't matter. Collectively they do, but individually there's no one sector that accounts for as much performance of the S&P 500 as this, and especially the NASDAQ, where it's over a 50% weighting. So XLV, healthcare. rallied off this level, getting pounded, but I had a key support level here, which we ever so slightly undercut. And again, the fact that we broke support but then recovered it right away makes that bullish, because that's a false breakdown. How much more does it carry up? Well, you can see a downtrend line coming into play right there. I don't have a strong opinion on that chart. Financials held the line right where they needed to. Remember, I had a purple line here where that's the get out of Dodge moment for the financials, but they hit it, symmetrical triangle, and bounce. And again, we had positive divergence. I pointed that out at the time, and that divergence is playing out. Where's resistance? Well, top of the triangle. There's our primary bear market downtrend line, or downtrend line off the highs. Remember, financials peaked earlier than tech. They peaked back in 2021. So that's where we're at there. We're kind of bouncing and getting towards the apex of this triangle. Sooner or later, we're going to break out. These symmetrical triangle patterns, they don't break out. They don't go down to that. I've never seen one go all the way to the apex. Just like rising and falling wedges, they usually break around this sweet spot, about 70 to 80% towards the apex of the triangle. So this one will break one way or the other sooner. I still favor this way. But we're in no man's land. We're between support and resistance. So there's really, no take right now on it, other than that's where it is. XLY, consumer discretionary. There was the purple key support level. Hit it like a champ and bounce. So that's the story of the market right now, guys. We hit and held. Remember, and I'm not even doing this right now because I'm going to wrap the video up, all those market-leading Magnificent 7 stocks, they hit, tested, and or held my key purple support levels. And so the day of reckoning, if it's going to come, it's just not here yet. This is just another reflexive bounce off support. And again, it coincided with the bottom in Treasury bond prices, which was the peak in yield so far. And the $1 million question is it going to be is this a reflexive bounce? I think it is. And let me show you a few more, and then I'll give you my final thoughts, and we'll wrap the video up. XLI industrials, again, a key support level right here, 96.53, positive divergence. So a lot of these things had these divergences at lows. You can have downtrend lines they're coming up on. A couple more here. XLC, communication sector. Again, I'm going down the line. Now we're only down to about a 7% weighting in the S&P. And of this one, it's really just two stocks that make up 30 roughly. Again, I have these a little bit dated. I haven't updated this since the end of 2022, so I need to do it. But back then, Meta and Alphabet made up about 40% of this sector. So it's a story of the market, and that's why you really only have to know where the big things are going, or the Magnificent 7 now, because they make up the bulk of the returns. And finally, I'm going to leave you with this. We'll look at this chart first, one that I've shared many times in the past. This is called the stages of a bear market. And there's, or the stages of a market cycle, really, whatever you want to call it. There's this stealth phase early on in a bull market where no one realizes, only the smart money realize that's what it is, because we're just coming off, remember, you're coming off the end of a previous bear market where most retail investors don't want anything to do with anything stock market related. And then the institutional investors start to come in, you start to pick up some steam, and that's the awareness phase where pretty much the masses by that point have come where, hey, guess what, bear market's over. And right about that time is where the dumb money, meaning the public starts buying, and you get your first sell-off in a bear trap where they think, oh, it was just a bear market rally, we're going down. But then that's where things really take off and you start going parabolic. That's the mania phase right there, right? You can see media attention, enthusiasm, greed, delusion. It's a new paradigm. We're in a great bull. Fed's finally figured it out. Market's going to go up forever. Correction, but there's a lot of denial. Then you get this bull trap here, return to normal. And this guys, I'm going to show you a chart of the NASDAQ in a second. And then all of a sudden, when everything looks like it's returning to normal, and again, I don't know, I always told you I work with a roadmap, a longer term map in my head. I'm not married to that map, but this looks a lot like where we're at right now. And just when, you've heard me say it last week when I started going long, just when this rally really starts to look good, and I thought it started to look good yesterday, and it looks even better today. just when it seems convincing to the masses that it's safe to get back in the water and the rally really starts to look and smell and feel good, even from a technical perspective, that's usually when the shoe drops in a bear market. And that's why you have those big drops. And then that will first result in fear, like I've been talking about on all the recent lows. Remember all those levels that I have, the key purple lines and all that, they get taken out, and we could see that. And we're not there right now. Just be aware that if and when it happens very fast, and they will not let you in, let you out of your longs. By that I mean, with another decent rally, and they're not going to let the shorts in that don't get in time. So you almost have to be ahead of these turns now. Okay, so take a look at this visually. Look at the how the bull market plays out, and then the ensuing bear market. And again, if it's a shopping mall and you walk in, you see a little sign, "You are here." Maybe we're right there. Maybe, we'll see. Let me show you the current chart. This is the NASDAQ 100. Okay, does this look familiar? There's your, that's just 09. That's when the last real bear market ended. So you had that stealth phase, then I mean, it just plays out. It's so canny. I've had this chart for years, the stage of the bull. You had the awareness phase where it starts to accelerate, first sell-off, bear trap. If you've studied the markets, or if you were trading back then, we had the first big correction. It doesn't look like a lot because I turned off log scaling just to kind of for effect here on the chart, but that was almost 20% and about a year and a half sideways. That was the first big correction, and then things picked back up. And again, you can just toggle back and forth between these. I wish I could have them both up at the same time. Then you really kind of took off, and then and the rest was history. And so if you tell me you don't see the similarities in this chart and the one I just put up there, and you can put the phases here, and now again I just pointed out the "you are here" kind of thing, and if it plays out that way, then again, this is why I have all those purple lines. We just tested them. We just pushed the upper limits of, or the lower limits of what the market could push, the upper limits of Treasury bond yields. And so what would cause that right now? I've traded enough bear markets to know that, again, you know me, and I'm going to wrap it up here. You know me, and I'm a big movie buff. I've probably seen every movie out there. If I would have read a book for every movie I've watched, I'd probably be the smartest guy in the world right now. I like books, but I love movies. And one of my favorites is this one here, The Usual Suspects. I guess this was, what, 90s? Mid-90s? I don't know when. And so this, if you saw it, you know the movie. It was a great movie, in my opinion. And this was Kevin Spacey before he got canceled. Played the character Verbal Kint, and he's in the detective's office getting interviewed. And again, if you've seen the movie, you know he was Kaiser Sose, who was the big bad guy that nobody ever knew who he was, but this super kind of mysterious bad guy known as Kaiser Soze. And so he was telling him the greatest trick the devil ever pulled was convincing the world he didn't exist. And so that's what bear markets are like. That's what this whole thing, this whole return to normal, if that's where we are, that's what it looks like. And so you have to convince the masses that we're not in a bear market. I've maintained that this whole run up has been a bear market rally. I have cited many reasons, including Fibonacci retracements, percentage gains, such as the comparable bear market rally, the only market close to the bull market we just came off of in history, at least in modern history, is the one leading up to the dot-com bubble in 2000. And in recent videos, not in the last week or two, but I've covered that in the last couple months, I showed you the 55, I think it was about a 55% bear market rally off the initial drop in March of 2000. No, this is right now. This is the highs right here. And but in this rally in the NASDAQ 100 was about the same thing. I think I have it at 58%. And I heard so many people, including on this site and TV, saying it's too big to be a bear market rally. And again, I think that's where people just get they don't look at the big picture. Everything in life, everything in the stock markets is relative, meaning a 55% bear market rally can only be just that, a bear market rally, if you're coming off a much larger bull market. And again, the Fibonacci's will tell you that. And this was about a 61.8 run-of-the-mill retracement. is 50, will go down on record in history if I'm right, and we are in a bear market with another leg down to come as one of the most powerful bear market rallies? Absolutely. But only because it superseded or followed one of the biggest bull markets in history. Okay, so I'm going to leave it there. And, the takeaway, if you're confused, don't know what to do, is that, just be careful right now. It's not an all-in moment, short or long. Right now, the current near-term momentum is up. Watch those Treasury bonds. Watch those Treasury bonds. They're going to tell you where the market's going to go. We're at resistance. If we can consolidate and power through that resistance that I showed you earlier, TLT and ZB, the 10-year, the 30-year Treasury bond futures. Look at IEF. Look at everything else. Then if they can punch on through here and rally up to the next levels, that should be net bullish for the stock market. But if you do see bonds continue to rally and all of a sudden stocks start to fail breakouts or get rejected off resistance, we could see that shift. And that's what I was saying in today's email. The post I got out to you, and it did go out to you by email, of course, if you're signed up for the email notifications, that we could see bonds continue to rally and stocks start to go down. It would kind of be a WTF moment for the bulls, not understanding why, and that would be important to see stocks starting to roll over. What does that mean? Get rejected off resistance level. This is IEF, but just say it's a stock. So rejected off resistance and then start to go on to break support levels while bonds still rally. That would be a change of character, and that would show that institutions are selling stocks because of this. I told you I would stop the video. I just can't. There's too many moving parts. I have one more thing to show you that I meant to show you earlier. Okay, let's talk. We're zoomed in here quite a bit, but let's go to today's employment data. I am watching that very closely, and I can assure you experienced and professional traders, investors are watching this, especially the macro guys that use fundamental analysis more than technical. I use them both. My background, business major, graduate, and career stockbroker before I did this, so I very much am tuned into the fundamentals and watch that. Only thing is it just takes a while. But one of the most important things here, you can, jobless claims. That's one reason the bond market's been rallying. Jobless claims yesterday, consensus was 213, came in hot at the high end of the consensus range. I don't know if you can see that on your screen. Consensus was 200 to 217 with a average consensus of 213. We came in hot, meaning more people filing for jobless claims. And then go to today, employment situation. This is a big one, and this is why bonds are rallying. And yet the stock market's rallying too, just because bonds are around, thinking, okay, low rates are good. This I promise you this, as much as I can promise. If this trend continues, this will take the stock market down, and it probably would see interest rates continue to come down. And that's where a lot of bulls will just not understand why rates are falling, because the single most important thing is the consumer. Consumer spending accounts for 2/3 of GDP. It has been a tremendously resilient job market. But here's today's numbers. And again, one day doesn't make a trend, but I'm going to show you trends, then I'll stop the video. Consensus today for non-farm payrolls month over month was 179. We got actual only 150,000 created, low end of the range. Unemployment rate, consensus 3.8, came in higher at 3.9. Private payrolls, consensus 143, only 99,000 jobs created for the month. Payroll, manufacturing payrolls were expected to drop 23,000, fell 35,000. So okay, you can go over the numbers. So across the board, bad jobs report, right? And again, I always say this in the stock market. I talked about that a minute ago. One day doesn't make a trend. But what does make a trend are multiple days, and when you see a trend emerge. Okay, this is the U.S. national unemployment rate. Okay, historical chart data going back to 1948 compares level, and okay, so as of now we're at 3.8. So what do I see when I see this chart? And I've talked about this before. Okay, this has been the one solid pillar that the bulls, those looking, think the market's going to new highs, going to take out the old highs, we're in a new bull market, is the low unemployment rate. And again, we're going back to the 50s here, 60s. This is modern times here. And although there is no set floor, you can kind of draw a line right about where we are, right? And if you want to take an average, we had a couple spikes down here, a couple that came in higher before the economy turned and the job market turned. But it's safe to say we're pushing the low end of the historic range, right? I think we can all agree on that. And the thing is, on this chart, let me blow it up for you a little bit. All bear markets, all recessions start from when things can't get any better. And what it is if you look really closely, I'm going to do that for you. These shaded areas here, from here to here, these are recessions. And what you can see, and this is also pretty much immutable when you go back in time, the job market always bottoms before the recession comes. Again, you bottom, and that's where recessions, and if you go back, and we'll do this real quickly, you can see, zoom down a little bit closer, and you can see a trend. Let's just go to this 10-year right here. Here's the trend. We have been ticking up. So the bottom, it's you know, you can really have to zoom in, and you can't say definitively that's not just one of these zigs or zags, but you can see here, this was the last one here before COVID. And COVID was kind of an outlier because it hit out of nowhere. COVID wasn't your typical, and the recession was over, you know, if you blinked, you missed it. You go back 20 years, and you can see, and go back 50 years. You study this chart on your own. I got this one from macrotrends.net. You can go there and get it yourself. And you can see once that turn comes in, the recession will then follow. And the government's always going to declare a recession in hindsight after it's started. So if you're waiting for the headline to hit on the Wall Street Journal, a recession is officially declared, you're too late. And you can also do this. I'll do this for you now, and then we'll stop it. Okay, remember the last real bear market? Here, let me go back 20 years. The last couple bear markets were, let's see here, I'm at 30 years. Okay, we know the big ones, the only ones that I consider bear markets. March of 2000 was the peak on the dot-com bubble. So that was somewhere right around here in early 2000. So the point is the stock market turns before the recession. The recession's declared in hindsight because, you know, a recession is defined as 2 declining quarters or negative quarters of GDP. And so therefore a quarter is over, you know, that's a 3-month period, and then there's a 1-month lag before the data's published. And even then, the NBER almost always goes in hindsight, and the data is revised after the fact, and it's always revised worse later on. So that's why if you're waiting for the recession to be official, you're already half, if not 2/3 of the way through the dang bear market. So don't try to use that as your timing indicator. But you can note that 2007 was October of 07 was the end of the previous bull market. That one went from October 07 to March of 09. So the bottom line is, first you'll see employment, the turn come. The trend starts to shift, unemployment starts to pick up, then the recession follows. And so here we are today. And it's starting to emerge as a trend. Again, I don't want to, say, can't say definitively, but when I've been watching these numbers closely, and we're seeing finally that last pillar, and that is always the last pillar in the economic cycle to go, is the job market. And when that goes, that's it. So there it is. Now this is macro stuff. You can't, it's not exact timing indicator. You can't time your QQQ day trades or short-term swing trades with this, but it does paint the bigger picture. And so, if we continue to see, this trend up, then it's safe to say the turn is in, and then the recession, that dark shaded box, will be right around the corner. Okay, I'm going to wrap it up here. Longer than usual video, but that's where we're at. So I'm watching Treasuries like a hawk, and I'm watching the key sectors and stocks and everything else. They're coming up to resistance, and I'll continue to update my thoughts. Like I said, you have to be a little cautious right now with the shorts, as long as Treasury bonds are rallying, and but then be ready. If the turn comes, it could come quick. All right, I'll wrap up here. This has been Randy Finney with Right Side of the Chart. Have a great day.